What's up everybody, I am Jaspreet Singh, and if you look at the number one issue that our country has been facing over the last couple of years, we went from our economy being completely shut down to fighting a global pandemic to having a toilet paper shortage to now fighting this major inflation problem. Now while this inflation problem isn't exactly something new, it's just not going away. Up until now, the government and the Fed's plan to fight inflation just hasn't worked, and now the Fed and the government are starting to change their policies on how the United States can fight the inflation problem. We started quote unquote fighting this inflation problem back in 2021 when the Fed originally said that they were going to create less inflation to fight the inflation. And then they said that didn't work, so maybe we'll have to hike interest rates a couple times in 2022. And then in 2022, the rate hikes actually came and they were bigger than what the Fed thought that they would have to do. And then they said that we can expect a lot more rate hikes. And then they said now we're just hoping for a soft landing in our economy. The Fed is really in between a rock and a hard place right now because on one hand, they want to fight this inflation problem, and on the second hand, they do not want to induce a major economic crash or a recession. Well, inflation happens when you create more money and you put it into the economy, and this helps asset prices like real estate prices and stock prices soar. We saw that happen over the last year. But then if you want to fight inflation, you have to do the opposite. Because when you do deflationary measures, meaning you take money out of the economy, well, that causes asset prices, stock prices, real estate prices to fall. So the Fed is trying to do this in a delicate way where they're trying to slow down inflation, doing it gradually without inducing a major economic crash, without causing major stock market meltdowns, without causing a major real estate turmoil. And so this is the balance that they're trying to fight right now. More specifically though, the United States is following a three-step plan to try to bring inflation under control. They want to first do it through interest rates, and I'm going to talk about how this affects the economy and asset prices, things like the stock market. Then I'm going to talk about the balance sheet, the Fed balance sheet, which is now something around $9 trillion that they want to reduce. And then I want to talk about supply chain and how the United States wants to improve the supply chain and how long this might actually take. So let me start by talking about number one with interest rates. This one isn't so obvious because sometimes it can be hard to understand how interest rates can affect inflation, but the easiest way to understand this is just by looking at what happened over the last couple of years. When interest rates go down, it makes borrowing money more attractive because, well, it's cheaper to borrow money. So when interest rates fall, more people are going to want to go to the bank, get a loan, and go out and buy a home. So if it's more enticing to people to go out and borrow money to buy a home, well, then more people are going to do that, which creates more demand for homes, and more demand pushes home prices up. Now, the interesting thing here is when this money gets lent out by banks, banks don't have a big vault of cash sitting somewhere. So what happens? Well, when you go to the bank to get a loan, money has to be printed. The bank works with the Federal Reserve Bank, and they have something called fractional reserve lending. It's a fractional reserve system where now the bank will print money, or the Fed will print money, they'll give it to the bank, and then the bank will give it to you. This is how inflation is caused. It's not just the demand, it's when you go to the bank, you go out and you get a mortgage, well now more money gets printed, and now you have more dollars to go out and buy a home. So when interest rates fall, more dollars enter our economic circulation, and this pushes asset prices up. Now I just talked about home prices, but you see the same thing happen in the stock market and really every other asset class because corporations can borrow more money, institutions can borrow more money, investors can borrow more money, and now you can borrow more money at lower rates. So you're going to borrow more money, more dollars enter our economic circulation, and this pushes asset prices up. Now, the Fed is doing the opposite. They are raising interest rates across the board, and we're seeing a number of interest rates hike. And we can expect a number of interest rate hikes in 2022 and probably 2023 as well, unless the Fed changes their course. Essentially, the Fed is still hinting at the fact that the reason why they're willing to raise interest rates and do this type of monetary tightening is because our economy is still strong, because we're not in a recession. And so if we do fall into an official recession, well, then there's a chance that the Fed could reverse their policies. But again, there's no way to predict what the Fed is going to do. We can say what the Fed should do, but that's not always what the Fed does do. So that's why the Fed could potentially change their policies. But again, I really have no idea what the Fed is going to do. So today, if we're in an economic environment where interest rates are going up, this reduces the amount of dollars in circulation because, well, less money gets printed and less people will borrow money and less money flows into assets. That does affect asset prices. I mean, the easiest way to see this is just looking at the volatility that we've been seeing in the stock market, especially the tech sector. Because this tech sector, the startup sector, this momentum sector, these companies for the last number of years have been running in a deficit, meaning that many of these companies have not been profitable because there's been no need to be profitable. Lots of dollars were just in excess. So if you were a company, if you were holding a profit, that was a detriment because that means you had cash in the bank that you weren't using because cash is a liability to these companies. So if you had $10 million in the bank, no investor would like that because they would say, why don't you take the $10 million and invest it in advertising, and then why don't you go out and take out another $10 million loan and hire more people, get more staff, open up more offices, and grow bigger? Because everybody in this tech sector, in the startup sector, is looking for scale, is looking for growth as quick as possible. So these companies are not holding onto cash, and now that interest rates are going up, people don't have that same mindset of, well, forget about profitability and just grow as quick as you can. Now it's switching. Where people want to see profitability. They want to see companies being sustainable. And now if you're a company that can't hit profitability, you're going to get hit hard. That's why the tech sector has been bleeding cash because these companies are now struggling. They're not able to keep up with their costs. We've seen hiring freezes across the board in the tech sector. We're seeing some layoffs in the tech sector. And this is just the beginning. If we continue to raise interest rates, eventually it will make business more expensive for many companies that don't have the ability to stay in business. So now if these companies in the real world, the economy, are hurting, they're bleeding cash, they're having to do layoffs, well, that's going to affect the stock market because many of these companies trade on the stock market. And so people have been worried, they've been selling. And the stock market also has a kind of a part of emotion in it too. Because when people get scared, they tend to sell, and that creates more panic, more selling, right? So you have to be smart here. And again, like I've talked about multiple times, when asset prices go down, this is where you want to look for the good deals. Don't just buy anything because you will see some companies shut their doors if we continue in this monetary policy where interest rates continue to go up, where we do enter a recession. Some companies will go bankrupt. So this is where you want to be smart. Look for the good companies, buy the opportunities. When asset prices go down, use it as an opportunity to buy at a discount. We've seen the same thing in cryptocurrency. I've been talking about this for almost a year now, but there's been a lot of exuberance in cryptocurrency where people thought that it can't go down, that it can't crash, and we're not going to see any harm happen to the cryptocurrency markets. But here we are. This is where, again, you're going to see similar things happen in the cryptocurrency market as the stock market, except the cryptocurrency market is even more volatile and even more speculative. So in the cryptocurrency market, there are a lot of coins, extremely speculative, completely worthless, and they will get hurt. Some of them, if not many of them, will go away if we continue down this economic path. So again, will cryptocurrency completely go away? In my opinion, no. I'm still buying cryptocurrency on my passive strategy every single day, and I will continue to do that. But again, I'm buying only a select few coins, things like Bitcoin and Ethereum and a couple others. That's it. And I understand that this is a small piece of my portfolio. It's in the speculative side of my portfolio. I understand that this is very risky, but I also understand that out of the cryptocurrency space, I'm not throwing my money into a bunch of random coins. I understand that the risk is there, and I understand that there's going to be a lot of volatility, especially when all this type of economic stuff is happening. To put it in perspective, even the Coinbase CEO came out and said that while the company is bleeding cash, even though they had a horrible quarter, that they're losing money hand over fist, that they are not worried about bankruptcy. Now, one thing that I want you to be aware of is when a multi-billion-dollar corporation comes out and they state anything about the word bankruptcy, even if they say that they're not worried about bankruptcy, you should be completely worried. Okay, because if a company is even mentioning that, these are things that you want to be aware of. Now, this doesn't mean that you necessarily need to pull all of your cash out of Coinbase and never use it again, but you got to be a little bit aware here because if the company does go into bankruptcy, that means that all of your assets in Coinbase would probably disappear. So what that means is, well, actually, let me rephrase what I said before. You should not be keeping your cash in any brokerage account, whether it's Coinbase or something else. You should be using a wallet. Now, ideally, you want to use a cold wallet, which is something out of the cloud. This is a USB drive. That way, you're not worried about whatever's happening with any of these brokerages. So you want to use a brokerage to buy and sell cryptocurrency, not to hold your cryptocurrency. But these are things that you want to be aware of. So if you're going to use brokerages, just make sure you're using a reliable brokerage, and even more importantly, make sure that you have your cryptocurrency in a wallet. And if it's not a cold wallet, at least have a hot wallet. That way you're not stuck within a brokerage, and if a brokerage goes down, you don't want to be one of the people that's not fighting to see if you can get some of your money back through a bankruptcy proceeding. So please take that as a little bit of a warning. This doesn't mean that cryptocurrency becomes irrelevant. It means you need to understand how you actually store and keep your cryptocurrency. And if you're looking for a potential brokerage to buy and sell cryptocurrency, you should check out our sponsor FTX US, because they make it super simple for you to dollar cost average and buy whatever cryptocurrencies you want. Now remember, don't forget all the things that I just talked about. You can expect a lot of volatility and a lot of ups and downs in the cryptocurrency market, so this is where you want to do your research. But the nice thing about FTX US is you can do a dollar cost average system super simply. So if you wanted to buy Bitcoin or Ethereum, well, you can enter in what cryptocurrency you want to buy, then you can pick the frequency, once a month, once every 2 weeks, once a week, once every day. You can pick the frequency, and then it's completely automatic. And the reason why I like FTX is because their fees are so much lower than so many of the other major brokerages out there. So now you can have more of your money being used to buy you cryptocurrency instead of just making your brokerage richer. But again, no matter what brokerage you use, make sure you use your own wallet to store your cryptocurrency. But if you're interested in using FTX, I'll put the link to how you can do it down in the description below. And the nice part is they are giving you Minority Mindset fans a free coin when you use my link down in the description, and then you enter in the referral code minority. If you do that and you trade $10, they will give you a free coin. So you got to use my link down in the description, enter in the referral code minority, and then trade $10. And then we have the real estate market, which will definitely be impacted by the higher interest rates. The real question is when. So I made a video recently talking about how banks are being a little bit more clever on how they can continue to qualify people to buy homes, because well, the cost of homeownership is skyrocketing, not just because of the price of homes, but because of mortgage rates. Mortgage rates are going up so significantly, making your monthly payments so much higher. So what are banks doing? Well, they're turning to adjustable rate mortgages. Adjustable rate mortgages are making a comeback. They're becoming a lot more popular as a way for people to get a mortgage right now. So this is what's happening to continue to help grow the housing market. But there's a couple things that you have to understand. One, the housing market is not as liquid as the stock market or the cryptocurrency market. So you don't see the same price fluctuations in the housing market or the real estate market that you do in other asset classes. Just like what we saw happen in 2008. When the 2008 crash happened, the stock market went down, and then it started to rebound in 2009. But the real estate market didn't bottom until 2012. So you have to understand that the real estate market is a much longer lag time. And as we start to see interest rates rise, you're going to see demand fall. Banks will try to boost demand through things like adjustable rate mortgages. And until institutions and these buyers start to slow down, that's when we will see the housing market also cool down. So you can expect changes coming in the housing market, but just don't expect it to happen today. You will see it happen gradually over time, because the housing market just moves slower than the other asset classes. The last thing that I want to mention regarding interest rates is how many interest rate hikes that we're going to see in 2022, because that is still uncertain. I mentioned how the Fed is willing to raise interest rates right now because the economy is still not technically in a recession. But if we do fall into recession, that can completely change what the Federal Reserve Bank does. So right now, it seems like the Fed is going to continue to do a number of interest rate hikes in 2022, and they will be at around 0.5% for at least the short term. So the prediction right now is that in June and in July, we will see a 0.5 point interest rate hike, and then we'll see what happens after that. Now, how many interest rate hikes are we going to see in 2022? Well, we're having a range. Some people say 4, some people say 7. We've already seen 2, and the Fed has already talked about potentially 2 more, and maybe more after that in 2022. So we don't know how many more interest rate hikes that we're going to see in 2022, but we can predict that we will see more coming. And then after we start to see more coming, after we get more economic data, then the Fed will probably reassess. Either they're going to continue with their interest rate hike to fight inflation, or they're going to stay the same and hope inflation doesn't get worse and hope the economy doesn't get worse. Or they're going to reverse course and say, okay, the economy is really struggling. We need to support the economy. So then they start stimulating, which will hopefully help support the economy, but that will make the inflation problem worse. So this is the situation that we're in with interest rates, which brings me to number 2, the balance sheet. The Federal Reserve Bank put out a press release talking about how they want to reduce the size of their $9 trillion balance sheet. Now, what I want to explain first is how this works, and then second, what the Fed wants to do. So the Federal Reserve Bank is known as the Federal Reserve Bank, but the interesting thing about the Federal Reserve Bank is that, one, they're not federal. It even says so on their website. They're not a reserve because they don't keep cash reserves anywhere, and they're not a bank because, well, you and I can't go there to bank. So the Federal Reserve Bank is this entity that helps control our monetary supply. And one of the things that they do is that they provide liquidity to the government. Now the question is, what does that mean? Well, if the government, the United States government needs money because they want to do whatever, well, then either they're going to have to raise tax dollars or they can go to the Federal Reserve Bank. Now, if you run on a cash-based system, what that means is your income has to be equal to or greater than your expenses. What that would mean for the government is their tax dollars have to be equal to or greater than their expenses because the government gets their money from tax dollars. Now, it's not a surprise that this is not the case because the United States government right now is running like a $30 trillion or so national deficit. What that means is that they've spent $30 million more, sorry, $30 trillion. Did I say 30 million? I am so sorry. $30 trillion more than what they have brought in through taxes. Well, they have to get this money from somewhere because if they just kept raising taxes on everybody, you'd see a lot of unrest because everybody would say, well, I am already struggling to survive. How are you going to keep raising my taxes? So they're not doing that. Instead, they create a silent tax because inflation is known as the silent tax. The way that it works is the government calls up the Federal Reserve Bank and they say, hey Fed, we are going to issue bonds, which are loans, and we need somebody to buy them because we don't think that the American people in other countries are going to buy up all of our debt. So we need somebody to issue us these loans. So then the government puts out this thing, this bond, saying that they need to raise $10 trillion or whatever amount that they need. And if people don't have enough money to buy it, which they don't, that's when the Fed comes in and they pick up the slack. So right now, the Fed has a balance sheet of around $9 trillion. Now again, the Fed isn't a bank. They don't have reserves. So what do they do if they're going to buy $9 trillion worth of assets? Well, they just print this money out of thin air. So the Fed prints this money out of thin air, and then they go out and they buy these bonds from the government, and now the government gets their trillions of dollars, and then they can go out and spend this money however they want. The Fed was able to help fund the government, and now inflation happens because more dollars get printed, the value of each individual dollar goes down, but the government has their cash to continue running their operations. So how do you fix this? Well, one way is, well, the government can cut their expenses, but the likelihood of that happening doesn't seem very high. So now the alternative is, well, the Fed can start selling off some of these assets because now the Fed has this investment portfolio of $9 trillion worth of assets. Now, a big portion of this are United States government bonds, meaning it's money that they loaned the government. And then the second biggest part is mortgage-backed securities. So these are loans for the housing market. And so Fannie Mae, Freddie Mac, they go and buy loans from banks. Banks issue you a loan, and then the banks don't want to hold the responsibility for the loan. They want to get paid right now. They don't want to be liable for people not paying the loans. So then Fannie Mae come in and then they buy these loans from the banks, then they chop it up and then they'll sell it to investors. And again, if there's not enough investors to buy these loans, either because they're not interested or because it's too risky or because investors don't have money, they'll go over to the Fed and they'll say, hey Fed, we got a couple $1 trillion worth of mortgage-backed securities that nobody wants. You want them? And the Fed will say, sure, I'd love to buy them. The most expensive kind of money that there is free money, because when you print this type of free money and you just inject it into the economy, it can create an inflationary spiral. And this is the issue that we're facing right now, because now it is multiplying and compounding the problem. Because now this money gets injected into the economy and this pushes asset prices up. Now asset prices go up and people feel like they don't have enough money to go out and buy assets, so they need a bigger income. So now if they need a bigger income, they go to the job and their company and they say, hey, I need more money. Then the company will try to pay them more money, and if they're paying them more money, then the company has to earn more money. If a company has to earn more money, they have to raise the price of their products, and if they raise the price of their products, then people will go shopping and say, oh, I don't have enough money to buy this stuff. So now they're gonna need more money. So it starts to create this inflationary spiral, and that all starts from this free money. It creates a compounding effect, and now the Fed is trying to combat that by doing the opposite. They wanna start selling off these assets. So when they were building up this $9 trillion worth of assets on their balance sheet, they were buying about $120 billion worth of assets every single month. So these are things like treasury bonds and mortgage-backed securities. Now they're finally starting to sell them off. Their plan is to sell off $47.5 billion worth of assets every month and gradually increase that month over month until they hit $95 billion a month, and then they'll hold steady there selling off their assets. So the interesting thing that we want to pay attention to here is, what does this mean for the bond market and for mortgage-backed securities? Because if the Fed is now dumping tens of billions, if not $95 billion worth of assets every single month, there has to be a buyer for them. And if there isn't buyers for them because people are running out of cash because of inflation, because they're scared to invest, because they don't want to invest, then that can impact bond prices, which can also impact the stock market. So now, as the Fed starts selling off these assets as a way to reduce the inflation by getting some of this cash and these assets off of their balance sheet, it has to be absorbed into the market, and this could push asset prices lower if there's not enough buyers out there, because then it creates more supply than there is demand. And this brings me to the third point, which has to do with the supply chain issues, because we're still dealing with supply chain issues. Now, these supply chain issues, many of them were caused because of the inflation, because in 2020 and 2021, we weren't producing anything except money. So people were still able to buy things even though we were in a recession, even though nothing was being produced because manufacturing plants were shut down, companies were shut down, but people were still able to shop and buy whatever they wanted because that's just what the Fed did. They gave money out and people had money to spend. So that created these backlogs, especially in this pandemic, because now people were able to buy things from companies. They didn't care about higher prices. People were able to spend whatever money they wanted. Companies didn't have products to sell. And this created this massive backlog. And now here we are today, and we're still facing the effects of those supply chain issues. And on top of that, China is still facing a number of lockdowns because of this pandemic. And so these things are just making the supply chain issues worse. And then on top of all of that, you have everything going on in Russia and Ukraine, which is not only affecting energy prices, but also food prices, because that part of the world is known as the breadbasket of the world. So we have a lot of different issues affecting the supply chain. And now the government is talking about how they can help improve our supply chain issues today. The presidential administration put out a plan on how to help solve these supply chain issues, and what they said in their plan was that they are creating a supply chain disruptions task force. Essentially what they're saying is that they want to invest more in our American infrastructure and manufacturing. They want to create funds for smaller manufacturing plants that they can lend to and get money from. That way they can invest in our own manufacturing here. They want to create a Buy American plan where the government has to buy products made in America. So they want to start emphasizing products being made in America, which makes sense. I mean, if you want to prevent these type of global supply chain issues, then the best thing to do would be to create your products here within the United States, because then you don't have to worry about things that are going on overseas. You can produce everything here in the United States and you don't have to worry about that. But the downfall is, well, cost, because it's significantly cheaper to do things in China, because now you can use cheaper labor. You can do it in India, you can do it in Vietnam. So you have a trade-off. Do you want cost, or do you not want to have to deal with these supply chain and trade issues? Now, if we think more of a global political landscape, if the United States were ever to go into a war, and now you start to lose ties with some of these countries, that's when it becomes extremely important to produce your own products here, that we're not relying on other countries. This has to do with something called the trade deficit. The trade deficit that we're facing right now is that the United States is importing way more than we're exporting. What that means is that we are relying on other countries way more than what other countries are relying on us, because we're not producing the products that other countries want. We are buying the products that other countries are producing. Again, there's a trade-off here, because if you produce everything in the United States, it's going to cost more money, but then you don't have to worry about these global supply chain issues. You can control the entire supply chain and you can control the entire manufacturing process by doing everything here in the United States. But the important thing for you to understand here is that while the United States government is investing in our infrastructure here, the more important thing to understand is that this investment isn't going to affect our supply chain issues right now. Because even if you start investing in manufacturing plants and do all this, it's not going to fix the issue today or tomorrow. So this is where you have to understand, how long is it going to take for our supply chain issues to kind of ease out where it is right now. And the easiest way to look at that is just by asking some of the companies that are dealing with the supply chain issues. And Mary Barra, the CEO of GM, says that the chip shortage that they're facing right now will probably last into 2023. So with all these issues and all this uncertainty going on, this is where it pays for you to be financially educated and not just rely on what somebody else, even the government or the Fed, is doing, because you don't want to rely on somebody else to take care of you financially. You have to be smart enough financially to look out for your own best interests. That way you can take care of yourself, you can take care of your family, and you can take care of your community. And you do not want to be relying on somebody else, an external company, an external factor to take care of you, because especially in this uncertain environment, people can be wrong. Entities can be wrong. The Fed said that inflation was transitory throughout 2021, and now here we are today with inflation being a much bigger problem than where we were just 6 months ago. If you enjoyed this video and you want to see why we might be entering a once-in-a-lifetime opportunity to build wealth and what you can do to capitalize on it, I already made a video covering it, and you can watch it by clicking that button right over there. Thank you for watching, and as always, keep hustling. When the 2020 pandemic happened, that was when the stock market and cryptocurrency was the biggest opportunity. Next time,